Hey, Weekly Wisdom, episode number 51. And today we're looking at this headline: How to Save $35,000 in Tax Each Year with a Trust. And I'm assuming if you've heard and seen that headline, the first thing you think is, I want myself a piece of that. Well, let's have a look at it and see how realistic it is. And also have a think about or a discussion about some of the things that this article has unfortunately overlooked in this debate. Let's turn him off. But it has overlooked some of the more finer details when it comes to saving tax. But it also highlights one of the things that we teach a lot when it comes to growing your wealth, and that is about having the right structure in place. So the headline: How to Save $34,000 in Tax per Year, and this goes through the fact that Australians pay a hefty amount of tax every year, not just income tax, but all the other taxes that they get thrown at us, including the GST and stamp duties and all those taxes that were supposed to go away when the GST was introduced but didn't. They're still there chipping away at our wealth. But anyway, the first thing that this article talks about when it comes to one of the more common tax structures used by the wealthy, and not just the wealthy, but people who have spent the time to understand how they can reduce their tax legally, and that's the trust structure, and having a discretionary trust that enables the trustees the discretion to determine who gets distributed the income from the trust. And so that's a key part of this particular article, is talking about the fact that you can set up these trusts and determine who the beneficiaries are, and then the trust itself is not necessarily a corporate entity, and so the income from the trust is then distributed by the trustees to the beneficiaries at whatever discretion they like under the terms of the trust deed. And so if we scroll down a little bit, as this points out, a beneficiary can be an individual, but one of the other things of a trust is that a beneficiary can also be a company. And so how it works is that you would do your investing through the trust structure, and grow your wealth through the wealth structure, or your assets through the wealth structure. And then it gets to this rather important element of the article when it comes to saving $34,000 a year. And it says, if, for example, you set up a $2 million investment portfolio in a trust, and in the next year you earned an income of $100,000. So I don't want to point out the obvious to too many people here, but there's not a lot of people who have $2 million investment portfolios generating $100,000 that are probably reading this article. But given that it's on a particular site here, but it would have certainly dragged a lot of people in to work out how can they benefit from it. And then they would have got to this table and gone, well, hang on a minute, that's not me. I'm not able to do that. So there goes the relevance of the article. But anyway, it talks about the different tax rates of mum and dad, and maybe a 13-year-old daughter, an 18-year-old daughter, and a company, and shows you, the variation in what's possible of distributing income to these people and their tax rates based on certain incomes. And so it does show you there's quite a broad range of different tax rates, and shows you that you could distribute money to the lower income earner to reduce the tax generated from that income in the trust. So that's really good. That is how they're designed to work. And you can pay them differently each year. You don't have to do the same percentages, and you certainly don't need to be fixed in the way that you go about distributing the income. It's all about moving it to where it's going to be taxed at the lowest rate, legally, of course. So you bring in an investment, bring in a company into the structure, and that certainly brings in a much lower rate than personal rates at the higher end of the market. And so it makes a suggestion here that the most common form of company in Australia is an operating business. We have an actual business that sells products and services. Makes sense. And you can also use that company for investment purposes. And they have a different tax rate to most individuals at the flat 30%. So it's appealing, particularly for those people with a higher tax rate than 30%. So it goes on to show how the company can also be used in the tax structure, and so distributions could be made to the company, and at the flat rate of 30%, pay a lot less tax than personal rates, particularly when you throw in all the other bits and pieces that go on. So you only need to be earning above 45% with $45,000 per annum, where the tax rate of 30% kicks in. So it highlights that the company tax rate is not marginal, it's flat, and so it doesn't go up as the income goes up. So it's very, very appealing. So then there's another table to show you how that impacts on different income levels, and this is where the $34,000 comes in, because it assumes that if you've earned over $200,000 in income, the company pays $60,000 versus the individual of $94,000. So once again, we're talking to a very small percentage of the population, because there are not too many Australians earning more than 200,000. Well, sorry, I shouldn't say there's not too many. There are a number, but the majority are not, and therefore, the relevance of this article drops away rather rapidly. But that's the headline, and obviously it draws you in, and it goes on to talk about that getting the right structure in place when it comes to your investing is very important when it comes to paying the least amount of tax legally that you can. Now, I mentioned that it missed or overlooked one of the most important parts of investments and tax on investments, and that is capital gains. And so one of the things it does not highlight here is that when investing in a company, they don't have the same benefits that an individual does when it comes to capital gains. So if you hold an investment for greater than 12 months, then you will get a 50% reduction in the tax or the capital gain amount in your tax for those investments, and the company does not get that benefit. So, this is not about giving you tax advice, but it is just highlighting that these articles have been simplified, and that there are other things to consider when it comes to deciding whether or not to set up these types of structures in order to take advantage of paying less tax. You also have to be aware of the negative aspects of going down these structures as well. And one of those, as I said, is a company does not get that 50% reduction for holding an investment for greater than 12 months. And so you're giving up potential gains at the lower rate, because you're paying it on the full amount of the gain. So very important to understand that, and to acknowledge that there are pros and cons to all of these things, in particular when it comes to tax. So be very, very mindful of those. Get some advice from your accountant to assist you with what is the right structure for you, and the right structure within that structure for investing purposes. But the thing I do like about this article is it is highlighting the need to have that conversation with your accountant, before going down the path of investing your money. Pardon me. So it's really important that you know what is the right structure for you, so that you can get the best result for your tax dollar and your investing dollars. So how to save $35,000 or $34,000 in tax each year with a trust, a little bit of an overstatement, and very much aimed at people earning over $200,000 in income and $100,000 from their investments. That is a small percentage of our population who are achieving that, and so a little bit misleading. But the good thing about this article is it does highlight the need to think about what structure you're going to use to grow your assets. And I am a big proponent of using trusts. They are a great way to protect your assets and give you the ability to discretionally distribute the income or the gains or income of the trust across the different beneficiaries at different levels of tax. So take advantage of that, and have the conversation with your accountant to get the right structures in place for your investments. So that's Woody's Weekly Wisdom, episode number 51. Thankfully, a different topic to interest rates and inflation this week, which is great. And if you can do me a massive favor, you've made it this far to the video. If you're watching on YouTube, smash the bell to get notified when these come out. Hit the subscribe button if you haven't already. And if you're watching on LinkedIn or Facebook, leave us a comment down below and hit the like and share button. Share this around so that other people in your network get to know what's happening in the world of money and wealth, and share the love so that everybody gains from these weekly wisdom videos. Have a great week. We'll see you again next week for episode 52. And as always, make smart money decisions. Cheers.